Hi, everybody, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're going to take a deep dive into variable annuities and what you need to know so that you don't get locked into a contract that may cost you way more than you bargained for. So this is our second video now. Second, right, Brian? Second video.
Yes.
In our larger series that we're doing called Annuities Exposed. Our first one was on MYGAs, or multi-year guaranteed annuities. You can check that out in the description below. But we really feel that this series is needed because whether you have an annuity, you're looking to buy one, or someone is trying to sell you one, the series is important because we're covering all types of annuities. But if you're looking at variable annuities, this is one you definitely want to watch to the end.
Yeah, Michelle, we're doing this because with so many different types of annuities out there, being complex and difficult to understand, you just don't know exactly what you're buying, right? And
Right.
Michelle, $254.8 billion worth of annuities were sold in 2021, according to LIMRA, which is the Life Insurance Marketing and Research Association.
Yeah.
Massive. It's annuities are a big business. And they can be a great product for the right person, especially when they're customized to the consumer's needs. So that's why we're running this series, Annuities Exposed. Today, though, Michelle, we're going to focus on variable annuities specifically.
Okay. Before we dive in, if you like the content of this video, we'd appreciate you hit that like button and also subscribe to the channel and hit that notification bell so you never miss another video from us on how to stop being a transaction and instead become an informed consumer with a solid financial future. Okay, so Brian, I'm about to sip. I got my teacup here, my unicorn teacup. Let's dive in. I'm going to sit back and enjoy some tea while I ask you some questions. Let's just start at the beginning. What's a variable annuity?
Simple explanation, a variable annuity is a tax-deferred retirement vehicle.
Okay.
And just like other annuities, Michelle, it's a contract between you and an insurance company. The insurer agrees to make periodic payments to you beginning either immediately or sometime in the future, right?
Okay.
And variable annuities are a little bit different than the other annuities that we've talked about because they offer a range of investment options. The value of your investment will vary depending on the performance of the investment options that you choose. And the investment options could be of a variable annuity could be typically mutual funds that invest in stocks, bonds, money markets, or maybe a combination of the three. And these options, Michelle, are sometimes referred to as subaccounts.
Okay. So if I'm hearing you correctly, variable annuities are used to accumulate funds for retirement, right?
Mm-hmm. Yep.
It grows it's a tax-deferred retirement vehicle.
Yes.
Correct. And so you put your money in. Once you reach retirement, you withdraw your funds or roll over or do whatever it is that according to the contract. That's pretty much it, correct?
Yep.
All right.
Every contract's a little bit different.
Yes. As with all annuities, all of them are, read the contract. That's what we always say.
Read the contract.
Read the contract. So how do a variable annuities work?
Well, basically, Michelle, they're designed for the ability to accumulate your funds for retirement. And once you reach retirement, we'll actually cover in this video some of your withdrawal options and how you withdraw them depending on your contract. So,
got it. Okay.
And inside of variable annuity, Michelle, it's broken down into two phases. The early phase of it is the accumulation phase. This is during the savings phase. This could go over a longer period, especially if you're adding to it, like on a monthly basis. And that's during the accumulation phase. The second phase is the distribution phase or the payout phase, when you actually start getting money back from the insurance company. But let's break them down. Let's talk about the accumulation phase first. You can either make a single purchase payment or a series of payments, like we said before. It's very common, Michelle, to see variable annuity, someone putting in like $50 a month or $100 a month into this. And that's your series of payments. And then sometimes you'll see some people say, hey, I got my old 401k. I like the market. I still want some accumulation. I still want some growth. and they'll roll over their old 401k or IRA, or even deposit cash into this in a single purchase payment. So,
Okay. I have a quick question.
mhm.
There are no contribution limits
Not during, not in a non-qualified annuity.
okay. But in a qualified annuity, which would be like an IRA, yes, you
Yes.
still have that 6,000 under 50.
6,000 and 7,000
over
if over
7,000.
50. Yep.
Okay. All right.
Yep.
Okay.
Yeah, them still stay the same. So this is the vehicle that you get to invest in. So,
Okay.
and inside this, during the accumulation phase, Michelle, your contributions are invested in, like I said, portfolio of stocks, bonds, mutual funds, and like I said, they're called subaccounts. You can decide where to invest your contributions based on your risk tolerance. And like before, I mentioned dollar cost averaging is common with these types of annuities, $25, $50 a month, depending on the contract. So that's your accumulation phase.
So what about the distribution or the payout phase?
Okay, this is where everyone's really likes this side of it, because this is the time you start getting your money, right?
Right.
Once you reach retirement, you got several options to take distributions depending on your contract. You've heard me say it and Michelle say it multiple times. Depending on the contract,
Right.
Each contract's different. So here's some of the normal distribution methods. One, Michelle, could be income payments, and that could be broken down into a lifetime payment,
okay,
joint and survivor payments, which pays lifetime for both you and your spouse, or for a period certain. Let's say, Michelle, you get to retirement and you say, look, I'm 65 years old. I want the most money I can get for the next 20 years. So you divide that out by a 20-year period, and that's what you receive. That's one distribution phase. Another one could be systematic withdrawals. You choose how much and how often you take these. And basically, it's kind of like taking monthly interest off the accounts. You let the other funds sit there and accumulate, still growing in your account, and you say, you know what? I've got my pension, I've got my Social Security. Give me $1,000 a month to play with, and you set up systematic withdrawals that way. And third, Michelle, is you take it as lump sum payments all at once. The problem with that again is the taxation due on all that. So we don't see that often, especially in the larger accounts. So,
okay, all right. So I think this is a good. Let's pause just a minute. I want to talk about the, how would I call it, advantages versus disadvantages, or the pros and cons. So let's start with, what are some of the pros of a variable annuity?
Yep. Same as with most annuities, the tax deferred. Sure. No taxes due until you withdraw the funds.
Okay.
A big one with variable annuities is the growth of your portfolio based on the investments that are chosen in there. And because they're higher growth potential, they could potentially outpace inflation and potential higher returns than some of your fixed rate annuities out there today. Okay.
All right. So what about disadvantages?
Number one, with all annuities, we talk about surrender charges.
Sure.
We'll hit that one second. The biggest disadvantage or con for some people in variable annuities is the investment risk. The investments that you choose inside the account, Michelle, could decline in value because you're still tied to the stock market, which could lead to lower payouts in the future. To me, that's probably the biggest risk. Second would be surrender charges, same as any other annuity out there. Variable annuities are made for the longer term, and many have surrender charges or early withdrawal penalties of up to 15 years.
Yikes.
So you need to read the contract. And then penalties, IRS penalties, of course, same as with most annuities, withdrawals before age 59.5 will be hit with a 10% penalty from the IRS. Okay. That's just a couple of the disadvantages. If we go a little bit further, let's talk about the fees. The growth of a variable annuity can be held back based on the amount of fees inside of it. Okay. Some normal fees seen inside this type of annuity are sales commissions, ongoing management fees, and cost of insurance charges, because annuities are an insurance product. So many of these fees, Michelle, we see them a little over 5%. And then also, compared to the one video we did on the MIGAs,
Mhm.
Most of these variable annuities don't offer a guaranteed amount, a guaranteed fixed amount like you would see in
Right.
a MIGA or a fixed annuity. So,
Okay. All right. So I want to do a deep dive into fees. You've mentioned it. You
woo,
just talked a lot
okay.
about it, right? The amount of fees is what I heard you say. So let's talk a little bit about, again, every contract's different. I
Right.
understand that there's different issuers, but how loaded with fees are these, and what do people need to be aware of?
They can definitely, like I said, up above, they could be like, 5% is a common amount total fees. Variable annuities are well known to be loaded with fees, some which are more visible than others.
Sure.
So I'm going to discuss a few of the main fees that you'll see in most variable annuities out there today.
Okay.
We'd already mentioned surrender charges.
Yeah.
Basically, real simple. If you surrender your policy before the end of the term, you'll be hit with early surrender charges. That's common with virtually any type
So
of
if you
annuity.
keep it to the end of the term, you don't have to
Yeah,
pay this.
you got it. You got it.
Right.
But in this one, they what's called mortality and expense risk charges. And in our industry, call it M&Es. These fees cover the risk the insurer takes in the policy, as well as fees to pay commissions. Usually are charged annually and are percentage of the account value from 1 to 1.5%.
Okay.
Another one would be administrative fees. And this is basically usually like a setup cost per
Sure.
year, like $25 to help with administration of the policy. And then we talked about the investments inside the variable annuity. So you got your mutual funds in there that have underlying fund fees. So each fund inside a variable annuity may have their own fees that are charged each year to manage them specific funds. And Michelle, them can range 1 to 3% annually.
Wow.
So
Okay.
pretty substantial there. And them are normal fees. And what also some add-on fees like rider fees or other charges. And depending on the variable annuity, Michelle, you can have specific riders or features that each could have a fee attached to them. Some examples are a income rider or a long-term care rider, a terminal illness rider, that kind of stuff. They're usually charged annually as a percentage of the account value. So as you can see, need to read the fine print of the fees of every variable annuity.
Okay. All right, let's talk about the death benefit options. What does that look like? Does it, we've done so many videos on annuities, but is it the same type of, setup where you have certain things that, how do I want to say this, have to be in place, where there's a clause?
Yes. Yeah, you really need to read the fine print. Each annuity insurer, Michelle, will have specific contract language regarding death benefit options.
Okay.
Read these closely. And here's a word of caution. If you're a spouse of the deceased, you may have different death benefit options, including the right to actually continue the contract in your name to full term.
Okay.
Know that. If you have a current advisor, have them run the scenario to see if this option even makes sense versus transferring the assets into your own name with a new annuity. And the biggest word of caution I can give you in this section is you're going through a lot right now if you just lost a spouse. Okay.
Right.
Please ask for a second opinion. Find a different advisor that can give you a second opinion in this case. And you don't like to make drastic decisions right off because of the mindset you're in. And I've seen many mistakes made during this period. So be cautious. So. But the payouts are about the same, Michelle, as any other type of annuity out there.
Okay. So what happens if, let's say I own a variable annuity? What happens if I pass or die before I stop taking payments from my variable annuity? How does that work?
Okay. So most annuities, Michelle, pay a standard death benefit.
Okay.
The initial premiums deposit could be the starting point and would lock in as the death benefit. Okay. And some of these, Michelle, reset annually. So to account for new highs in the account or new deposits being put into it. And they don't decrease except for withdrawals. Each account may have their own specifics as far as benefits. So if you die before starting taking payments, you've got multiple options, whether it's going to be a lump sum or take it out as an income stream. It just depends on the insurance carrier. Be very careful in this section here. Also, we talk of a lot of caution because these are more sold than bought. But think about this, Michelle. I talked about the annual reset index, and it might have a lifetime high value. So let's say, Michelle, you started, your husband started this account at $100,000.
Okay.
He grew the annuity to $210,000 at all-time highs, and then dropped down to $75,000 because of the pandemic. Let's use that for an example, or the Russia, what's going on with Russia, Ukraine. Okay, we dropped down, right? Now, that just because it hit the 200,000 plus up there, we were able to lock that value in, and that is now your death benefit.
Understood. Okay.
I understand that when an advisor wants to try to replace this annuity, because it's not the account value might only be 75,000, your death benefit is 200,000.
Right. Right.
That's just wrong. So be careful on that. So
okay. All right. So that's if you die before you start making payments. What happens if you die after you start what happens if you die after you've started taking payments from the variable annuity?
Okay.
Same thing?
Depending on the annuity, the payments may cease or may be converted to a lump sum payout to the beneficiary. Okay. Make sure you read the fine print on that because each contract is completely different. These are just some of them. During this expose, we want to really give you the stuff to think about before you sign on the dotted line about these variable annuities, because you need to understand the death payouts. If I was going to give you any piece of advice on variable annuities today, before you sign the contract, I don't care what the mutual funds are and that kind of stuff inside there. Go to the payout section and read the payout section first and see what the contractual guarantee is in the payout section first before you decide of, oh, this can accumulate and make me a lot of money, but what's going to happen if I pass away? You really need to understand that. So,
yeah. And on this note, I have a quick public service announcement. If you currently have an annuity, or even if you're looking to get an annuity, or you have any other type of financial product or investment, make sure that your paperwork is where someone knows where to find it, is not shoved in a brown bag, been shredded 10 years ago, and or hidden on some super file in your computer, or some hidden file in your computer.
I've seen that.
My own family, you're like, wait, what? You find some contract and you're like, hey, is this what we've been looking for 2 weeks? Found it. Anyway. All right. So I just have one more question for you to wrap this up. I want you to talk about the taxes. What does that look like?
Pretty simple. Variable annuities are taxed based on the funds used to purchase. If it's qualified funds or non-qualified funds, just like most other annuities. If you come in with qualified funds, and what I mean by that is pre-tax dollars like an IRA or 401k account, you'll be taxed when you withdraw the funds. It's considered income and you'll be taxed on both the principal and the interest earned in the account.
Okay.
But if it's non-qualified, this is like cash from your bank account, you'll be taxed only on the interest earned, and it uses LIFO, which stands for last in, first out basis for the taxation of it. So,
all right. Okay. Anything else that we need to know about variable annuities that I have not asked?
There's so much more you can go into, but as far as the basics for the variable annuities, one thing I would say to consumers out there, if you're looking to purchase one or you already have one or someone's trying to sell you one, please get a second opinion first. Yeah. And then, and share this video. If you know someone is trying to purchase an annuity and they're talking about one, let them listen to this first. If you're If you got questions about the variable annuities or any other type of annuity, drop it below this video. If you're watching this and something piqued your interest, drop that question below, because this helps us make our content better for you folks.
Sure. Absolutely. All right. Well, on that note, if you've made it this far, if you're still here at the end of this video on variable annuities, hit that like button. Make sure you subscribe to the channel and also turn on the notification bell so you don't miss another video from us. And that way, when we release our next video in this Annuities Exposed series, you will be notified. All right. Well, thank you so much, everyone, for staying to the end. And thank you, Brian, for all this information. Appreciate it.
Thanks, everyone. Thanks, Michelle. Bye.